CoreLogic Strategic Plan, prepared by Matthew Miller, Nathaniel Waldschmidt, and Scott Kozak. With technological advancements always coming to fruition and ever-changing housing markets, it is important to stay ahead of the competition through technological innovations coupled with portfolio diversification. These key concepts can be further utilized by a leader in the information intelligence industry, CoreLogic. This strategic plan will provide insight to CoreLogic's SWOT analysis in addition to other information about the company's standing among the industry. This strategic plan will also cover other strategic options CoreLogic can capitalize on to further increase their market shares and EPS. CoreLogic provides information for multiple industries to identify and manage growth opportunities and is based in Irvine, California. Industries include real estate, mortgage finance, insurance, or the public sector. Services include financial property and consumer information, analytics, and business intelligence. Analyzes information, assets, and data to provide clients with analytics and customized data services. As of December 31st, 2016, CoreLogic had around 6,300 employees, 5,600 employees in the U.S. and 700 outside the U.S. CoreLogic has 1.9 million square feet of leased property throughout 24 states, including Austria, Canada, India, France, Mexico, New Zealand, and the United Kingdom. CoreLogic also develops proprietary research and tracks current and historical trends in consumer credit, capital markets, real estate, fraud, regulatory compliance, natural hazards, and disaster projections. In 2016, the reported revenue was $1.9 billion. CoreLogic's vision statement is, CoreLogic vision is to deliver unique property level insight that power the global real estate economy, differentiated by superior data, analytics, and data-enabled solutions. Their mission statement is CoreLogic mission is to empower CoreLogic clients to make smarter decisions through data-driven insights. CoreLogic's customer groups are commercial banks, mortgage lenders, brokers, credit unions, investment banks, fixed income investors, real estate. Their technologies are real property, mortgage information, consumer information, loan information, proprietary technology, software platforms. The customer needs are hazard concerns, market concerns, ease of use, customization, and access to information. An existing strategy that was used by CoreLogic is horizontal integration. The acquisition of FNC Inc., a leading provider of real estate collateral information technology and solutions that automate property appraisal, ordering, tracking, documentation, and review for lender compliance with government regulations.
In reviewing the external forces that could impact CoreLogic, one of the key areas to look at is, of course, the economic forces. When reviewing the economic forces that could impact CoreLogic, one of the things that was brought up continually was the fact that CoreLogic has approximately 70% of their business tied into the mortgage industry. So as the mortgage industry goes, so does CoreLogic at times. So the industry experts saw that the very heavy home refinance market was very beneficial the last few years to CoreLogic's bottom line. So much so that they thought maybe that heavy refinance market was hiding things from CoreLogic's bottom line and other places that maybe weren't going so well. CoreLogic, as a result, made a very conscious effort to try to diversify their offering to be not so dependent on the mortgage industry and offset that risk. So if the mortgage industry starts to take a massive decline, CoreLogic themselves would not be taking as big of a decline as well, and they would have other opportunities to be making revenue if the mortgage industry would go down. As we saw at the beginning of 2017, many of the mortgage rates went up for the first time in a very long time, and a lot of that mortgage refinance business, as predicted, started to go down. Now it hasn't gone down as much as some of the experts had suggested, but it's still gone down, which impacts the ability for CoreLogic to make revenue off of their mortgage-related products. The forecast for the refinance market obviously is lower than it's been in the previous years, and that potential loss of revenue has made it so that CoreLogic has had to account for that in their fiscal year upcoming. So how they respond to that, what cuts they might have to make, what other areas they might have to improve upon to ensure that revenue is being generated even with a downturn in the mortgage arena. How the mortgage or how the housing market plays out for 2017 will definitely have an impact on CoreLogic's current and future strategic plans, depending on the amount of revenue that they're able to generate in other areas and just how much of a loss they end up taking in the area of the mortgage. Continuing on the topic of economic forces and the impact that it might have on CoreLogic, one of the areas that we previously discussed were the mergers and acquisitions. CoreLogic has put a lot in their portfolio in recent years, so much so that the analysts say that in the goodwill area and the financial statements, it looks like CoreLogic has approximately $2.1 billion tied up in mergers and acquisitions. They noted that when CoreLogic recently acquired Mercury Network to bring onto their business. Part of that diversifying is obviously weighing quite heavily on CoreLogic to try to compensate for market changes or economic changes in order to stay profitable. However, those investments are so heavy that some question whether or not CoreLogic can generate solid revenue from having all those companies on board. Obviously, bringing in those mergers and acquisitions means that CoreLogic has to figure out how to integrate those companies, how to streamline or incorporate those companies through processes, strategies, that all those companies had, and how do those fit within CoreLogic? How do they bring those people on board? Who do they keep, and who might be let go? As you can see as well on the slide here, that CoreLogic recently opened up a brand new office in Dallas to bring aboard several of their Texas area employees or Dallas area employees, while other offices in the area were closed to consolidate down to just one office to again offset some of these mergers and acquisitions and the costs that come with them. And sometimes that's in the standpoint of the amount of offices that you now have and what can be closed and what can remain open. One of the other external forces that we look at with CoreLogic is political, legal, and governmental forces. One of the governmental forces that impacted CoreLogic is the Federal Reserve raising the interest rate after years of remaining stagnant. While the interest rate rising can help consumers with their savings rates, it does impact the mortgage rates that rise because of that. When the mortgage rate goes up, there's less refinances, as we've discussed with some of the other external forces that can impact CoreLogic's bottom line and ability to generate new revenue. As well, state governments are starting to become a little bit more stringent on how and what insurance companies can write business in their state. Insurance companies that are looking to expand have to work with the state and the Department of Insurance to apply to write business and show that they can write business in that state. Some of these states have become very restrictive in what companies and what they will allow to be written in that state. This is not allowing insurance companies to expand the way they would like to or at the speed they would like to in some cases. If insurance companies can expand and start to write business in new states, that could mean new revenue for CoreLogic if they're using CoreLogic products. One example is the state of California, which requires a specific report or data be provided to all consumers that are looking for home insurance quotes. This is a customization that has to be done for any insurance company that's looking to provide quotes in California, but might not have to provide that same type of data within the other states that they write. This can become a barrier or slow down insurance companies from expanding into that state. Those are some of the political, legal, and governmental forces that CoreLogic has to account for. The next external force we review is technological forces. Obviously, with any business, there's a pressure today to stay cutting edge with your technology. CoreLogic being a data and software company, it is vital to their business to try to stay ahead of the competition. That pressure can force them to be pushing towards more technological innovations to try to keep up with competition. The insurance industry as a whole has made a large push to automate and expedite business as quickly as possible. They want their agents or computers to take quotes from consumers in a very quick, efficient fashion to have a competitive edge to try to get business before any other competition would. Because of that, it's forcing CoreLogic to evaluate the technology that they have, the software that they have available, the data that they have available, all those areas to ensure that they can meet a client's demands and keep a book of business that is sound enough to generate more and more revenue year after year. Other smaller startups have started to enter the space as well in the insurance industry and some other areas of the industry from a mortgage perspective. One of those is companies that offer pictures via drones. They can send these drones in times during a hurricane, maybe it's after a wildfire, or it could be during a flood. Any of those times when it's tough to get some boots on the ground, so to speak, and get somebody in there to look at it right away from the insurance company, instead they can send the drones to go take the pictures and bring that back to the company. Some of these smaller companies are taking specific addresses or areas from the insurance companies, going and taking pictures and bringing it back. So while it's not a complete data set from point to point like CoreLogic could offer, it is still a force that CoreLogic has to account for. Continuing our conversation about technological forces. As we said before, technology is an area that always needs to be moving at a rapid pace for a majority of businesses today. For CoreLogic, what they decided to do back in 2015 is partner with a company called Pivotal Labs. Pivotal Labs is known for their innovation in generating and creating software in a very quick fashion, in a way that is small and packageable, what they call a minimally viable product that a company could take to market and test it, look for market acceptance, look for other feedback from the market, and depending on that feedback and acceptance rate, then they can come back, create a full product, take it to market, and do a complete launch. Otherwise, they can go back to the drawing board and start all over again. It allows for failures to have a minimal impact on the bottom line or the revenue, and it also allows for a lot of work to be done with clients that truly understand the need of the client and incorporate that into the technology that's being used. CoreLogic brought Pivotal Labs in-house and has them in 2 offices, one within California and one within Texas. CoreLogic is leveraging their innovative approach to the software development approach and trying to instill that within their own culture as well. The next external force we look at is competitive forces. CoreLogic's primary competition comes from Verisk, specifically in the insurance area. Verisk offers very similar data and solutions to CoreLogic, just in a little bit of a different format. Verisk also tends to offer automotive insurance data and things like that, whereas CoreLogic does not work with the automotive industry. They focus primarily on property data. When a client is looking at different competitors for using insurance data or getting insurance data on property, typically there's only CoreLogic and Verisk. There are very few other players within that arena that insurance companies would trust to provide them software. One other competitor that is a little bit more specialized in their data and used more for larger data analytic sets would be LexisNexis. They do a little bit more on the property data side, sometimes more with the mortgage area, but LexisNexis is one competitor. There are other competitors as well. Some are smaller and they compete with certain aspects of CoreLogic's data, but not on a whole with CoreLogic. One of those would just be as simple as Google Maps, which can do some of the same, what they call geocoding, as some of the CoreLogic software, where you're pinpointing a property on a map or using the latitude and longitude to try to find exactly where that property is on a map. Here is the external factor evaluation matrix that we put together for CoreLogic. Looking at the key external factors within the opportunities, we looked at leveraging new technology offerings, as we discussed, such as drones or even smartphone apps. The international markets with limited property data that might be out there, such as Australia or New Zealand. Diversifying further into the renters market to take advantage of the millennial market that's out there performing or renting. And continuing to look at strategic mergers and acquisitions to bring in more property data as a competitive advantage. The threats we looked at were startup businesses stealing smaller segments of business potentially from CoreLogic, mortgage rates continuing to raise higher, some states continuing to limit the new books of insurance business that might come on, and competition price cutting on contracts that try to take away CoreLogic's clients as they are the industry leader. One of the one of the pieces that we weighted out here the most was, as far as opportunities, was the strategic mergers and acquisitions, as this seems to be a key opportunity for CoreLogic to continue to build on their property data set to achieve a competitive advantage over their competition that does not have that data. And then we also looked at the technology and some of the other foreign markets that could use CoreLogic's data and generate new revenue there. From a threat perspective, we definitely felt that the mortgage rates continuing to rise higher could have a very large impact on CoreLogic and the reliance that they have on the mortgage industry right now to generate a large part of their bottom line. This is the competitive profile matrix that was put together for CoreLogic. We put together some of the critical success factors that we saw out there for CoreLogic and their competitors, and then rated them all across the board. We have increased revenue. We gave this a fairly hefty weight at 0.2, as obviously that's kind of the mainstay for a lot of businesses out there. We felt that CoreLogic had the stronger ability between the three to really generate new revenue, utilize the data that they have, and still build on the business that they have, given that the other competitors are facing the same challenges. Expanding into international markets, it seemed like all challengers or all competitors in this arena would all have that same ability. Gaining market share, CoreLogic is very saturated into the insurance industry already. Verisk is a close second behind CoreLogic, maybe a little bit further behind, but since they are newer to some companies, or they try to be the low-cost leader in some capacity, they might have a slight edge over CoreLogic and looking to gain some market share this year. Brand awareness, CoreLogic and Verisk both beat out LexisNexis, both very sought after for their brand in the insurance and property arena. Industry expertise, quite often CoreLogic is used for quoting in the mortgage industry, the insurance industry, for different hazards and things like that. Whereas Verisk, you see some quotes, but not as much as you would from CoreLogic. More people are turning to CoreLogic for that expertise, and not often is LexisNexis sought after for that. Financial stability was the same across the board for all three. Diversified data offerings, again, all three in their own way offer a little bit different of diversified data. In the end, you saw that CoreLogic seemed to come out the most favorably based off of their industry expertise, their ability to keep creating revenue, and kind of stay on status with the other ones in the other areas. From an internal perspective with CoreLogic, one of the first areas that we looked at is management. CoreLogic obviously prides themselves on their property intelligence and property data. They're constantly looking to expand on the quantity and quality of the property intelligence, and that's been an ongoing pursuit for them, whether that's through mergers and acquisitions or through utilizing the data across the different companies that they've already compiled together. CoreLogic leaders have positioned themselves as industry leaders. They are sought after to be speakers. They are sought after to be experts in writing white papers. They are sought after by Wall Street to provide data on why a hazard could affect financial arenas such as mortgage and insurance and things like that. One area of note is that recently the CEO of CoreLogic passed away suddenly, and the CoreLogic had to elect a new CEO, Frank Martell, who has only been the CEO for a few months with CoreLogic now. So we'll see what kind of impact that has, negative or positive, for CoreLogic in the coming months. The next internal area we looked at was marketing. CoreLogic provides the largest data set of property data and intelligence in the industry. It speaks for themselves, the level of data that they have on all the properties. They're globally recognized. In England, they are sought after for their risk data. They're starting to reach out into Australia and New Zealand. In Asia, they have a brand out there for risk management as well, and very well known in North America and especially through the US and Canada. CoreLogic is firmly planting themselves into the decision-making process for financials and insurance companies and properties. So it makes them a very sticky company So from the side of getting the mortgage closed on a home to getting new insurance on that home and evaluating all the renewals on that insurance that was written on that home. So CoreLogic is finding a way to insert themselves on all those different areas and making them a very sticky partner to a lot of their clients. Again, the recent acquisitions, they're gaining a larger and larger customer base that's going to come under the CoreLogic umbrella. From a finance and accounting perspective, CoreLogic is focused on overcoming their mortgage-heavy position based off what analysts had told CoreLogic, that they were concerned about how much of their revenue is based off of how the mortgage industry goes. They have made a slight shift, and as we've talked about, moved into acquiring some other businesses that will help them spread that risk out. In 2016, CoreLogic had a record-breaking year, and they're looking to build upon that in 2017. To compensate for some of the difficulties they foresee with the mortgage industry, they have planned for $30 million in reductions based off their annual plan, or their annual review from 2016. Next, we'll discuss production and operations for CoreLogic. One area of note for CoreLogic is that they are global. They have offices throughout the globe. One of the other areas we've discussed before is that they do have numerous acquisitions. Some of those acquisitions and mergers, there are some operational efficiencies that have been gained in the upcoming months based off of whether it's office space, employees, or operational pieces that are redundant. They are also, again, as we mentioned before, looking to do a $30 million in reductions during 2017 to help gain some efficiencies. CoreLogic stated in their annual report that they talk about the difficulty of integrating or completing future acquisitions because of really the amount of acquisitions that they've had, and trying to pull all that together and have what they would call one CoreLogic, and everybody operating in the same direction, the same mission and vision, the same values, and really trying to drive that all together to create a competitive edge as one CoreLogic. The next area for CoreLogic is research and development. CoreLogic has invested heavily in innovation to try to create that cutting edge technology that will, again, create the competitive edge that they want within the insurance and mortgage industry. As discussed before, they have opened up 2 offices for Pivotal Labs to help create cutting edge software. And they have the software now that can be taken to market quickly, tested quickly, and determine feasibility, and get it out the door as quickly as possible to stay ahead of competition. Additionally, in Dallas, Texas, they built a global innovation center to help spur on innovation throughout the company as a whole. In regards to the management information systems for CoreLogic, again, CoreLogic has dedicated themselves to cutting edge technology. They have several technology centers set up throughout the United States. Primary ones are in Plano, Texas, and Quincy, Washington. They use a third-party company. Previously, it was Dell, which has now become NTT Data, to manage all of their data centers. And they've created a state-of-the-art cloud presence for their internal use and for their clients to use as well. Here we have the internal factor evaluation matrix for CoreLogic. For the key internal factors, we looked at the strengths that we put together for them. Some of those that we had was strong revenue performance last year, and they've had it previous years prior to that as well. They have diversified data offerings on property. The Pivotal Labs that we've talked about as a technology catalyst for them. Having best-in-class property data. The industry expertise that's sought on the home market, and industry expertise that's sought on natural disasters as well. Some of the weaknesses we identified was having a brand new CEO, the heavy debt that they've taken on due to mergers and acquisitions, and having a high dependency on the mortgage industry. Within these, we gave a heavier weight to the strong revenue that they've been able to generate, the diversified data offerings that they have, as well as the Pivotal Labs technology, and having the best-in-class data available out there. And then within the weaknesses, we did feel that the heavy debt that they've taken on due to mergers and acquisitions is something that should be addressed and reviewed as part of their ongoing strategy.
Strategy development. In order to increase customer loyalty and satisfaction, gain new customers, increase the number of services and benefits offered by CoreLogic, and remain competitive, we are recommending an investment in drone technology to gather post-disaster data. Drone use will reduce the time to inspect a loss and allow for increased efficiency after a major disaster. This will positively affect the speed at which customers are able to receive settlements and reduce fraud by quickly documenting pre and post disaster conditions. Drones will streamline our processes and save a considerable amount of time long term. This will increase company revenues by 15% over 3 years through market expansion and penetration of drone surveying to gather post-disaster data is our long-term company objective. CoreLogic's proposed expansion into the drone market requires having many different, more specified objectives within that. And a lot of those are as follows. Our annual objective would be, of course, to increase divisional revenue by 5% in 2017, 2018, and 2019. Research and development is to develop a proprietary 3D mapping and surveying software that is integrated with CoreLogic's data sets, which would in turn provide real-time claims for cost projections. Our production objective would be to increase data collection and processing by 20% this year, which would be a pretty substantial goal, but we would feel it would be more than attainable. Marketing objective would be to develop advertising, promotional, and public relations collateral for the drone technology introduction by the fourth quarter of 2017. Develop drone operations and procedure manual for internal compliance with the new program. Along with that, our financial objective would be long-term financing of about $20 million in the next year, so we can get all of the proper equipment and technology for the drones. Personal objective would be we'd plan on adding 10 staff members, 2 of which would be would have a focus on FAA regulation compliance training, and we'd have a total of 8 certified drone pilots. Our second area of focus in our strategy development would be international market expansion of property data, and to capitalize on CoreLogic's globally recognized brand and try to offset the downturn in U.S. mortgages by expanding property data and analytics service internationally, focusing on key markets of Australia and New Zealand. By introducing an existing product into a new market, we can increase our revenues with limited overhead costs, expand sales into the global marketplace, and develop new data sets for future research and development activities. And here we have our list for our objectives with regards to our international expansion. Annually would be increase divisional revenue by 5% in 2017 and 2018. Develop property data and analytics products this year that are successfully marketed to the Australian and New Zealand markets. Production objective is increase the property data coverage in the Australian and New Zealand markets by 30% each year. Marketing objectives is increase the number of salespeople by 3 this year, 2 for Australia and one being designated for New Zealand. Our financial objective is to obtain long-term financing of $500,000 in the next 6 months to launch operations in those countries and establish our other objectives that we talked about. And for our personnel objective is develop leadership and culture training for international businesses and best practices, as we all know that can change from country to country and even region to region. Historical financial statements. So this is the first of 4 slides which contain all the snapshots from CoreLogic's historical financial statements. In this slide, amongst all the numbers and data, what I like to point out, and I want you to remember, is in 2015, we look at the sales growth was 8.76%, which was actually the second to lowest growth out of the snapshot here. So just keep that in mind, and I'll bring that up again in the next couple slides. The next slide we're looking at is a clip of the SG&A expense. Selling, general, and administrative expenses are the sum of all direct and indirect selling expenses and all general and administrative expenses of a company. These expenses, which are not directly tied to COGS, have increased from $334.23 million in 2012 to $454.55 million in 2016. Over the same period, gross income has increased from $504.2 million to $738.94 million. This part of the historical financial statement, we're looking at the interest expense, pre-tax income categories. And as you can see here, from that 2012 to 2016 period, there was a lot of fluctuation and a lot of ups and downs. And we have arrived at our final slide of the historical financial statement. And if you recall, in the first slide, I told you to pay attention to the 2015 sales growth. To remind you once again, that sales growth in 2015 was the second lowest of the whole 2012 through 2016 trend, was at 8.76% growth. What I find very interesting is pointing you towards the net income growth of that same year was astronomically higher than any of the other ones at 43.8%. And this net income is, I think, a very important thing to pay attention to, talking about the pulse and true health of a company. According to Frank Martell, President and Chief Executive Officer of CoreLogic, he says, throughout 2016, we invested in our products and solutions, technology leadership, and operational improvements, which we believe will sustain and expand our long-term market leadership. This leadership in our durable business model has allowed us to return over $1 billion to our stockholders over the past 6 years, including $195 million in 2016. It is important for CoreLogic to consistently and constantly pay close attention to net growth income, as this is what the company is actually putting in their pockets, so to speak. The sales growth percentage is an important indicator to pay attention to when it comes to market trends. However, like we talked about in the previous slides, putting both of these into context with the statements above, the net growth versus sales growth, once again, they displayed one of their weakest sales growth percentages in 2015, yet had the highest net income in that 5-year period. This indicates that CoreLogic implemented cost-saving measures to offset the smaller sales growth, which boosted their net income. Turning our attention now to the financial ratio analysis, the company's long-term growth has been actually very encouraging at 12% CAGR. The company has a high debt burden of 1.59 billion and a debt to equity ratio of 1.56. This is mainly due to acquisitions, which is not necessarily a bad thing. We wouldn't call this necessarily bad debt. Despite this, CoreLogic has a reasonable return on invested capital and equity at 5% and 8.9% respectively, and a good free cash flow margin. CoreLogic maintains its status as an attractive investment opportunity to any potential shareholder. Here we're looking at the projected financial statements. The graph to the left is revenue in regards to net income and profit margin. And to the right, it's revenue in regards to operating income and operating margin. CoreLogic's profit increased from 208.17 million in quarter one of 2016 to 216.55 million by the end of 2016. Net income for CoreLogic has declined, however, in the past year from 27.48 to 15.44. In addition, earnings per share have dropped from 0.31 to 0.15 during the same period. These figures represent sort of poor bottom line growth and kind of a sagging business. The stock price for CoreLogic declined during the last trading session, negative 0.52%, while the S&P 500 did gain 0.47%. Sales declined in the last quarter. However, medium-term growth has been good. Operating margins have been healthy during the last year at 12.9%, while the industry average is 8.6%, which is actually still a very, very good sign for CoreLogic. And net margin was higher than the industry average over the past 12 months. Total current assets are assets that have a life of 1 year or less. This figure has declined in the past year from 476.59 to 413.83 million in 2016. Current liabilities are less than 1 year until full maturity. For CoreLogic, total current liabilities have increased in the past year from 585.79 to 688.39 million in 2016. Total equity of the business has decreased from 1,094.91 last year to 1,015.85 this year. CoreLogic will need to take steps to cut costs the remainder of the year to accommodate the decline in the assets, increase in liabilities, and decline in total equity of the business. And here we're looking at the chart, which involves 2016 results for CoreLogic and a 2017 outlook and guidance for assumptions upon which projections were based. "2017 guidance assumptions for CoreLogic are mortgage loan origination unit volumes expected to decline approximately 20 to 25% from the levels of 2016. Next would be realization of target gross cost savings totaling at least $30 million. Diversification of client-based and appraisal-related revenue associated with our valuation solutions group. Flat US dollar currency translation rates against the Australian and New Zealand dollars and the euro compared to average 2016 actual rates. And the repurchase of $3 million in common shares of CoreLogic.
Through the EPS EBIT analysis, we see that CoreLogic's best way to fund the strategy suggestions would be through combination financing. We see through common stock financing and debt financing that the EPS would actually be lower than the 0.083 EPS CoreLogic would gain from combination financing.